Georgia Congressman, member of this morning, the House Budget and Energy and Commerce Committees, Earl Buddy Carter is with me, along with former CBO Director and American Action Forum President Douglas Holtz-Eakin. Still with me, Donald Luskin and Rebecca Walser and Todd Pyro. Great to see everybody. Douglas Holtz-Eakin, your thoughts, your reaction to this number?
This is a good report. We know that the top line's been driven a lot by gasoline prices, energy prices in general. To see the core come down a little bit, I think, is good news. As Donald Luskin mentioned, this is all about the shelter inflation component. You know, it peaked at 8.2%. Last month it was at 7.2% year over year. It's got to come down some more as the current prices feed into the index, and so it looks like that happened. That's a reverse from last month. Last month we got a surprise up on shelter. That went away. I think that's probably the key.
Rebecca, would you buy into this stock market rally here?
Well, no, Maria, but that's just because I'm overall bearish. But I do think that the consumer is going to be happy about this. We're not going to maybe see rate hikes. You know, I know CME was only at 26%. That we even see anything else anymore. That's going to even drop even further now. But, you know, the consumer might feel like, okay, maybe things are coming down and I can spend a little bit more on Christmas. So that it will be good for retail, and I'm excited about that.
Todd, it's a good report right before the most important economic indicator, and that's the holiday season.
Yeah, and to Rebecca's point, yes, that would be ideal if that happened. I just don't know if every time we've seen a good inflation report over the last 12 months, if the prices of bread, milk, you know, eggs have dropped precipitously so that I go to the store and they're like, my God, it's 2019 again. I understand realistically we're never going to get back to 2019. But at the end of the day, these numbers, great for Wall Street, great for investors, great for the people who deal with money. But for the common person on the street, this isn't a comment. This is a question. Will there be any significant change to that bill when they go to Stop and Shop, ShopRite, Publix, wherever? Are they going to feel it?
No, you're not going to get further spikes. It's where it was last month. So you're still talking about elevated inflation. It's just not getting any worse with this most recent number. Buddy Carter, you're there in the House talking with your colleagues about a stopgap measure. You've got a good economic report this morning. Does that nudge people closer to an agreement? Where are you on this funding package with the Friday deadline looming?
Well, I certainly hope it does nudge our members to an agreement. It should. You know, let's face it, inflation is still a problem. Let's hope that the Fed does not rain on our parade. Let's hope that they keep interest rates the same. But as far as Congress goes, yeah, I'm very optimistic that we're going to get this two-step ladder plan passed this week and continue with the government funding and avoid a Christmas omnibus. That's one of our main goals, is to avoid that.
I'll tell you, yields are plummeting right now, down 14 basis points on the 10-year, sitting at a level of 4.49%. We just broke 4.5 and 4.49% on the 10-year. Doug Holtz-Eakin, that's got to be good for our interest payments.
Yeah, anything in that direction would be good for the federal budget. You know, 50 basis points of higher interest rates get you a $1.5 trillion in additional deficits over the next 10 years. I mean, we have so much debt that the federal government's a highly leveraged entity and very exposed to interest rate risk.
And your thoughts on this two-step plan from Mike Johnson?
Anything that gets you to yes. I mean, you need 218 in the House and 60 in the Senate, and they're working on a way to get there. And so there's a key vote today. That's worth following, and we'll see if we can get there before the Friday deadline.
Yeah, Don Luskin, what about that? How much does this potential government shutdown work its way into your modeling and your analysis?
Oh, just absolutely zero. I mean, we've seen this movie 100 times before, and it's so boring, we always just get up and get our popcorn. Okay, just move along.
Just move along because what? You don't think a government shutdown matters?
Well, I mean, if you're asking me what impact it'll have on the economy or the markets, then my answer is just move along, because it has never, ever, ever had a visible consequence. It's just not a thing. It's good inside baseball, and we can watch our friends in the legislature fling feces at each other, but it has absolutely no effect on the markets.
Well, we got a market that is rallying right now off of the highs, but certainly showing a gain of better than 280 points on the Dow Jones Industrial Average. Rebecca, you just said you would not buy into this. Are you going to sell into it?
You know, Maria, I think we're just there's so much data, and I understand that Donald's really bullish, but you know, there's too many bearish signals that I still see, and obviously the geopolitical, you know, two international conflicts that are both still raging and one just starting. I see a lot of red coming. I'm sorry, I just do.
So you think we're going to see a sell-off in stocks in 2024?
Or even before, if we have some economic developments that happen before the end of the year. I still think we're going to get news before the end of the year. So I think people should be prepared.
Mm-hmm. Inflation in America of 4% from October 2022. Todd Pyro, you made the right point earlier that it's not going to really impact people at the cash register right now because it's a continuation of what we saw the month before. But I can see Joe Biden coming out and trying to take credit for this today. I'm guessing he's going to do a press conference. I don't know that for sure, but I would bet on it.
Maria, you took the thought right out of my mouth, and I want to highlight a discussion I had on Friday, and basically it was this. Expect to see the stock market go through the roof magically thanks to some of Joe Biden's friends in the upper echelons of Wall Street. I'm looking at computer trading. You guys know this stuff way better than me, but the explanation was these algorithms are going to be tweaked so that Joe Biden's economy all of a sudden looks great in 2024 going into the election. Is this the first step in that process? We will see.
Yeah, Buddy Carter right now, given that this administration keeps pushing its Bidenomics, and they're going to today probably say this inflation report is because of it.
Oh, there's no question they're going to take credit for this. But let's keep in mind, don't let things get too out of control here. When the Biden administration took over, inflation was at 1.4%. And don't worry, we're going to remind the public of that. We're going to continue to remind them of that. But they don't need to be reminded of that. 72% of Americans right now say they're worse off than they were when the Biden administration went into office. So the consumer confidence is still not there. And yes, these numbers are better, but they're still not what they need to be.
I mean, do you think that it's been economic policy has been worse or foreign policy from this administration? I mean, the border has been an ongoing issue, and this morning we're reporting on this House GOP report that says that the illegals community in the U.S. is going to cost taxpayers $451 billion a year. What does that mean? That our taxes are going to go up? We've got to pay for this?
Absolutely, that's what it means. And do I think one is worse than the other? I think both are bad. I mean, I tell people all the time, I'm the second happiest Carter in Georgia now. The happiest Carter is Jimmy Carter because he's no longer the worst president in history. Joe Biden is.
Well, look, we got a market that is rallying this morning on the CPI number up 312 on the Dow, the NASDAQ up 243. Don Luskin, what do you want to say that the skeptics do not understand about your bullish analysis?
Well, I think that what we don't understand, so you've heard it in this panel in the last 10 minutes. Everybody's focusing on the fact that even though we have a 0% change in CPI on the month, that doesn't fix it for consumers who still remember what the world was like before the pandemic and before the largest inflation that we've had since 1980. So this was a generational shock. It's not enough to simply have zero inflation, and the Fed's going for 2%. But here's my bullish forecast, and you heard it here first. Starting in January, February, March of next year, this slowdown in inflation is going to become outright deflation. And by next summer, there are going to be minus signs in front of CPI, in front of core CPI on a year-over-year basis. And all the economists are going to come on CNBC and they're going to say, oh, my God, you know, it's going to be like the Depression because we have deflation and nobody knows what to do with deflation. Well, consumers know what to do with deflation. They buy more. America's going to go on sale. We're going to get back in at least the direction toward the price level we had before the pandemic. So let all the super bears say what they want on CNBC, here on Fox Business. I'm giving you an advanced look at what the very happy future is going to be.
Well, just to be clear, I mean, you know, inflation is still up 4% year over year. I mean, you said it's zero and the Fed is, you know, targeted 2%. Yeah, okay. But year over year, we're talking about inflation at 4%. And Jay Powell was quite clear the other day when he said, yeah, inflation is not where we need it to be, which is 2%. He left the door open for further rate hikes. Are you telling me, Don Luskin, that you don't think the Fed is going to raise any more? from here on out?
Oh, they're absolutely not. And, that's not a wild-eyed thing to say. I mean, the futures curve and the money market curve has been saying the same thing for weeks. The only question is, when will the first cut be and how many cuts will happen how quickly? I think the first cut's going to come in March because central banks don't like deflation. You think they don't like inflation? Well, wait till they see deflation. And that's what's coming. But the secret sauce is this is going to be a good deflation.
A cut in rates in March is what you're expecting. Let me tell you, if you think that the Fed is going to cut rates in March, then I've got to believe that the Fed is reacting to a recession, reacting to a sharp slowdown, to think that they're going to raise rates 11 times and a couple months later they're going to cut rates in March.
Well, they're going to see the monetary deflation. They're going to see minus signs in front of CPI. Okay. And in their model, which is wrong, but it's what they believe, they are going to think that is precursor evidence of a recession. It won't be. But even if they don't think that, and I think they will, they're going to cut rates because the whole reason they raised them was to lower inflation. Well, right. If you've got deflation, you've certainly more than lowered inflation, so why wouldn't you cut rates?
Yields are plummeting. You got the 2-year now down 16 basis points. You got the 10-year down 15 basis points right now on the 10-year at 4.48%. Rebecca, I have a feeling you're on the other side of that trade that Don Luskin's talking about. Yeah,
he's the super bull. I'm a super bear, and we're going to see who's right. But I think, all of his points are super valid. Obviously, I'm a data person. I see the math. There's just, Maria, I really am concerned that we do not even have Moody's outlook turning negative because we can't even, have a budget process that makes sense. We constantly have to do continuing resolutions, debt ceiling problems, which obviously is through the election. There's too many outside macroeconomic factors that are against growth. And I do think that he's right on that.
I wonder how important that Moody's downgrade is, Douglas Holtz-Aiken. They were at stable, and now they're at negative, downgrading the U.S.'s debt, obviously because of the $36.5 trillion in debt this country faces. Your thoughts?
Well, certainly the negative watch is merited. The federal government budget is fundamentally unsustainable. There's been no demonstrated evidence of the ability of the House and the Senate collectively to do any real budgeting and take on the programs that matter, which are the large entitlement spending programs. They're fussing over the annual discretionary. It's a tiny part of the budget. It's not going to fix the problem. So, that downgrade fits the data. If I could, I'd just like to make a couple points about the economy. I'm in between, I think, Rebecca and Donald. But if you look at that 4.9%, 1.3% of that was just an inventory bump. You take another 0.8, which is just government spending, sort of classic Bidenomics. And so you had 2.8% that was private demand. Of that, it was all consumer, zero in the business sector. That should worry you. Right? When the business sector stops doing CapEx, that's the typical sign of a downturn coming. I see no reason to think that we're going to have a boom. I think we're going to have a really flat fourth quarter, and I'm worried about downside in the next year. So, certainly there's no reason for the Fed to raise rates, but even if they stay where they are, they're going to be tightening by bringing down the portfolio, by letting inflation decline, having real rates rise. So this is not a scenario that looks to me like either robust growth or a recipe for deflation. It's more flat on both sides.
It's a great point. And Don Luskin, what about that? What about the fact that we're hearing from companies guiding lower in this earnings period, and we're also watching inventory and watching invest spend, and it's not keeping pace? So isn't that an early indicator if businesses are not allocating new money for investment?
Well, yeah, you say what you will about the guidance on an anecdotal basis, but on a total, say, S&P 500 basis, looking at every company, all 500 of them, bottom up, year-ahead forward earnings are the highest they've ever been in history. So if that guidance isn't satisfactory, well, God, imagine what it would be if they had better guidance, because we're talking about world's record earnings expected a year out, even with the bad guidance. That looks pretty good.
What about investment spending? Business spending?
Well, so you mentioned inventories. Inventories have been very lean since the pandemic. And of course, one of the reasons why is because the supply chains were damaged, so it was actually difficult to accumulate inventories. Now, we've repaired all the world's supply chains. Inventories are now back up to slender levels, not inflationarily lean levels. And yeah, I guess you could say that we'd like to see more business confidence and they're stocking their warehouse with more stuff. On the other hand, if something does happen in the economy and there's a little shock, you can't say we have a big inventory overhang where everything's just going to have to be sold on a fire sale basis. You know, that's what creates the vicious cycle of every recession, and we're just absolutely not set up for that.
Well, Todd Pyro, this story is going to get crystallized in the coming months because you've got the holiday shopping season, which will give us a clear indication of where the consumer is around the holiday. And then you've got another month to assess business spending. And we'll see where that is. There certainly have been many on Wall Street who have pushed out their expectations for a recession. First, it was coming this year.
Right.
It was going to be a tough fourth quarter. Yeah. Now, many are actually saying, OK, let's wait. We haven't seen the impact of these 11 rate hikes. Recession in 2024. We'll see if that's the reason the Fed ultimately cuts.
Again, Maria, maybe I am too skeptical. Maybe I'm too cynical. But I truly believe that we want to view this from the macroeconomic money perspective. I think politics will play a much bigger role in what happens in 2024 because there are forces out there, and we've talked about this. This is literally what this network and this show talks about mostly, that want to keep Donald Trump from the White House. And they want to keep Joe Biden in there regardless of whether they think he can actually complete his term in office. And I think those are going to be the ultimate impacts on this economy. That said, I do have a comment, Congressman, for Buddy Carter. If Mr. Luskin's view of a potential recession hits and rates do drop, can you, and you win all three branches of government, a lot of hypotheticals here, can you take that $451 billion that's currently going to pay for non-American citizens, going straight to illegal immigration, and maybe, I don't know, pay down some of our debt and refinance at the lower rates?
I certainly think that's a great idea, and I think my colleagues in Congress would think that's a great idea, at least those in the Republican conference. And I got to tell you, this is a serious problem. Our debt right now, the four top line expenditures in our budget: number one, Social Security; number three, Medicare; number four, defense. Guess what number two is? The interest on our debt. We cannot continue this. This is unsustainable. That's why you see what's going on in Congress right now. I know it looks like a mess, and it is a mess, but we're trying to restore fiscal sanity. We've got $36 trillion in debt, and the interest on that debt is killing us.
Yeah, and that's something that you're focused on, Doug.
Yeah, amen to that. What this country needs more than anything else is to take the federal budget and put it on a sustainable trajectory. It is the biggest headwind to economic growth. When you take $1 from private sector investment and put it into the government, it goes at best to a government investment that has half the rate of the return. It goes otherwise to consumption spending, zero rate of return. With these huge deficits, we just have a machine for anti-growth. No productivity, no rate of return. And that's not fair to workers who aren't going to see their wages rise. It's not fair to the next generation. And it's dangerous fiscal policy. We need to do much, much better.
And Donald Luskin, just to be clear, I don't think you are expecting a recession, right, next year?
No.
Oh, no. Thank you for clarifying that. No, absolutely not. Just the opposite. I mean, we're in a productivity-led boom. There's going to be no recession next year.
Yeah. I want to get your take, Don, on the way the Bureau of Labor Statistics calculates health care insurance. That's a component of the CPI, and they used lagged retained earnings from insurance companies to determine whether there's been inflation or deflation in the space. Has that been part of the makeup of this number? Do you know?
Yeah, I believe it has. I haven't looked into all the deep methodological stuff with that, but this is just like owner's equivalent rent. I mean, these guys at the Bureau of Labor Statistics, they're just so smart they're stupid. I mean, it's just consumers know what healthcare costs are, and they're not looking at the profits of S&P 500 healthcare companies to figure it out. That's just plain ridiculous, but that's how they do it.
Are there areas that you believe are worth investing today, given this bullish stance of yours, Don Luskin?
Well, you could just throw a dart and you'd hit a winner, but you're going to think I'm crazy considering how well these stocks have already done this year. But, I believe the AI-driven stocks are, absolutely revolutionary. I think We've got a chance to go back to the early 80s when the personal computer was first introduced. And you wish you'd bought Microsoft on the IPO? Well, you're going to get to do all this over again with all this AI stuff. It's going to absolutely change the world. And as to the political risk next year, thanks to AI, the intelligence we have in Washington may be artificial, but at least we'll have some.
Rebecca, your thoughts in terms of investing in those companies that have led the market year to date?
You know, Maria, AI is the frontier. He's 100% right. But I just want to caution everybody, and certainly investors out there and Wall Street, we are basically investing in our own obsolescence. In other words, the human person as a contribution to GDP will become a thing of the past, because we are talking about the complete, takeover of all jobs by AI. We're not just talking blue collar, burger flipping and fry making. We are talking about neurosurgery. We're talking about ChatGPT writing legal briefs. We are talking about the end of human contribution to GDP eventually, and that's where we're headed. So let's maybe just really look at this, like Elon Musk said, let's look at what we're really investing in before we just decide and we wind up and we're all out of our jobs.
Well, look, I don't know that there's anything wrong with having computers or a machine to help that cancer surgeon, to help that doctor who's using technology in an effective way. I don't think it puts that guy out of a job or that gal out of a job. But Buddy Carter, should there be legislation around AI to counter those fears?
Let me tell you, it is one of the hottest subjects on Capitol Hill right now. Last week at the Doctors Caucus, we actually had AI experts speaking to our conference, speaking to the Doctors Caucus about the use of AI in healthcare. And no, I don't think it's going to replace healthcare professionals, but it's certainly going to play a big role. Today in the Energy and Commerce, Communications and Technology Subcommittee, we will have a hearing on AI and the impact it is going to have in our communications. All of that. AI is one of the hottest subjects on Capitol Hill right now.
What I'm worried about is AI in the military, and I don't know what is possible. For example, for some of our adversaries, like a China, using artificial intelligence with regard to weaponry.
That's absolutely true. And the Defense Committee has been studying this and talking about this. This is something that we've got to be concerned about, and we've got to address this. We all understand that. It's difficult. There's no question about it. But I do feel like we're in a good position where we can address it for the future.
Doug, do you think that there is money from businesses allocated there? I mean, there are certain areas of business that are a must spend. Security is one of them. I'm wondering if AI is another.
Well, I think AI is responsible for the surprisingly strong performance of business investment in the first half of this year. I mean, it was clearly weakening coming out of last year, and it firmed up pretty markedly. So I think that's the AI investment. That's all those chips, and certainly people provisioning for the security necessity and some new products. But it's going to diffuse into the economy relatively slowly. I do hope it does exactly what you said, Maria, which is we get some better productivity in the health sector. That's been an underperforming sector for a long time. That'd be tremendous. And the other thing to remember is that, on this show, we talk about the economy and we talk about Wall Street, and we forget that most firms aren't publicly traded. Most jobs aren't associated with the forward-looking earnings. They're associated with, small businesses and not-for-profits, and a big chunk of the economy doesn't look anything like what we see in these data. And so that's what I've been looking at. How strong is that part of the economy? And it doesn't look near as robust as the rest.
Well, Todd, when you go out and you're walking about with other families, do you feel that the sentiment has changed? Do you feel that spending has changed?
I think to a certain extent. I mean, you're not going to have individuals cutting off spending completely, especially with the individuals that I'm hanging around, because we all have kids that are under 3. So, those kids need certain things for life, so you really can't cut. But I think to your point earlier, it's all going to come down to Christmas. That's where we see the discretionary numbers. That's where we're going to see, did I get little Tommy 3 toys this year or 10? And I think that ultimately will be, to Donald's point, what leads the discussion in January, February, and March.
Piper Sandler this morning writing, we expect deflationary pressures to persist in goods and shelter, with the latter continuing to catch down to already slowing rents, something that you mentioned earlier, Don Laskin, in terms of shelter. Part of the issue keeping home prices higher is there's not enough supply.
Yeah, that's true. But I just want one of the things that we have to come to terms with is we've had just a tremendous backup in mortgage costs for people who want to buy new homes or change their existing home for a new existing home. And the activity in transactions in new home and existing homes really hasn't budged. I mean, there was a gigantic, sort of bubble just right after the pandemic when rates were so low. But we've now stabilized at levels that are above the pre-pandemic level, above the rising pre-pandemic trend, despite these mortgage rates. So there is not only a shortage of housing in this country that's driving that, there is also, after the pandemic, a change in people's lifestyles where they are more willing to be mobile and find bigger homes so they can do Zoom calls, someplace other than their kitchen table. Move to a state like what I did in Texas, where I don't have to pay taxes.
Yeah.
Housing is the new thing.
So real quick, tomorrow PPI, are we going to get a similar showing in the PPI when we get that tomorrow? And you want to take on Walmart? Walmart's taking market share in this environment where people want to pay less because they're worried about inflation. Any thoughts on what's to come this week, Don?
Well, PPI is just going to be just a complete shocker because the closer you get to sort of commodities in this morning's report, it's just got minus signs everywhere. So, but that's not going to surprise anybody. But I think what we're already seeing is the reason why we had a zero CPI report just for the month. I understand it's just for the month.
Yeah.
Is companies like Walmart and Costco. They really haven't moved their prices now for 6 or 7 months. Now, that's not the same as moving them back down to what people remember just 3 years ago.
Okay.
But the first step is to just stop raising those prices. That's already happened. Stop and enjoy that. That's the first step. Now comes number 2.
We will be hearing the opening bell sound in 30 minutes' time. Dow Industrials at the highs of the morning, up 370 points on the Dow, up 275 on the NASDAQ after we got a better than expected inflation report. No change for the month of October. And better than expected on the year-over-year number as well. Buddy Carter, Doug Holtz-Aiken, Donald Bluskin, Rebecca Walser, and Todd Pyro, thank you.